The value of a stock and a fund is not calculated the same way. A stock price doesn't have a NAV, a net asset value. A fund has a NAV, and it's the sum of all its holdings. So then we have the problem when you have a fund and you have an exchange traded fund, an ETF. What's the difference? Well, nowadays you can start an ETF without having a fund. But before, you first had a fund and then you created an ETF. So people have access to it and they could trade it just like an equity. Well, then you have an arbitrage because the NAV is set on a daily basis on most mutual funds, but the stock price or the ETF price, it can change during the day. So what we had when I was working in the bank, we actually had a client that had an ETF that they issued based on their own fund, and then they had a special ETF class so they could regulate so that the ETF price was in line with the NAV of that day. Now, this mechanism doesn't exist now in today's ETFs. And when you look at an ETF that's out on the market and it doesn't have an underlying fund with the NAV, you really have to look hard at what is the ETF really worth, because everything extra you pay on top of its holdings is what you pay for the manager, for the fund manager you think is so good that they will in the future somehow produce more than if you would buy every single holding separately.